Welcome to Business Uncut. My name is Anna, the practice manager at New Wave. I'm joined today with Jameson Smith, commercial lawyer from MBA, and Callum, Farrugia, client manager at New Wave. Today we are delving deep into shareholders agreements, selling and buying into businesses, restructuring, and we'll also touch base on some of our frequently asked questions from business owners. So Jameson, first thing clients always ask, I have a company constitution, why would I need a shareholders agreement? Can you touch base on what a shareholders agreement is, how it differs from the constitution and benefits from a legal standpoint?
Yeah, for sure. So the number one thing we always say to any client, especially when they're going to go into a business with a mate or a silent partner or whatever the case may be, is if there's going to be more than one person, always get a shareholders agreement. Relying on the constitution of the company is tough. So the constitution doesn't go into too much depth with respect to, dividend policies, drag along, tag along rights. These are just all things that our shareholders agreement will cover. If you don't have a shareholders agreement, you need to rely on the replaceable rules, and that's under the Corporations Act. So they deal with kind of internal governance for your company and for the shareholders in there, as well as some directorship, voting and things like that. What I would highly recommend is obviously the shareholders agreement, because those will include things like buy-sell insurance policies. So where a shareholder suffers a permanent disability or an occurrence of death, what happens with their shares, having those insurance policies in place to be able to pay them out. So it's a seamless transition. You got tag along and drag along rights, which is your ability for minor shareholders to stop sales and your majority shareholders to force sales. So there's a lot of other provisions in a shareholders agreement that aren't touched on under the constitution or replaceable rules. So your best bet is to always come speak with a lawyer. If it's me, that's awesome. And then we can kind of go through those different clauses and things we would recommend in those scenarios.
Okay, and is this something that you have to do from the start, or can you adopt a shareholders agreement years into the business?
You can adopt it anytime you want. It just makes it a lot harder in the future. I would always recommend doing it straight away. If you do it into the future, your shareholding might have changed. There's a number of things that can differ from when you first started. That needs to be dealt with straight away. And honestly, the number one thing we see most is when one partner influxes more cash into the business than the other. And how that's dealt with is a little bit harder without a shareholders agreement. So do it straight away. Best advice I can give someone.
And can you amend shareholders agreements down the track if the business has changed?
Yeah, you can amend it anytime, but you'll have to pass a resolution as decided in that shareholders agreement. So normally it'll be a unanimous decision to amend the shareholders agreement, or at least a 80% decision. But a lot tougher to amend it down the track if things change again. So again, the idea is come see a lawyer, come see an accountant, kind of do some pre-planning where you think the business will be in 5 years, 10 years. How can we deal with that under a shareholders agreement? Much better to nip it in the butt now than deal with it later. Okay.
And who pays you for this?
The company will technically pay us. So we will act on behalf of the company, and the shareholders can, I think we'll touch on this soon, but can go out and see their own independent lawyers to get legal advice on what the shareholders agreement means for them. But the company will pay us for our service.
So you look after the rights of the interests of the company.
Yeah, correct. Which in turn is the shareholders, but it's a grey area, and we always just say, hey, look, we're instructed by the company, which is obviously you guys, but you actually do need to go out and get your own legal advice about what this shareholders agreement means for you and everything like that.
Perfect. And how long does this whole process usually take? Let's say from the day that I give you a call.
Yeah, it can vary. We've had some shareholders agreement take 48 hours. We have some take 6 months. We've had clients spend quite a bit of money, a substantial amount of money, especially more in group holding scenarios. So where company A owns shares in company B, C, and D.
Okay.
How those rights work, especially when potentially company B has employees that they want to bring up to a shareholding level. It can vary, but ideally, we're a service-based industry, so we do things very quickly at MBA Lloyd.
So 6 months would be because there's a lot of back and forth, not because
Correct.
you're out playing golf.
Yeah, correct. No. I don't play golf. I'm chained to the desk.
Perfect. Okay, so the shareholders agreements, if anyone's ever read it, the language can be quite confusing. So let's touch on some questions that clients would ask. What does first right of refusal and preemptive rights actually mean?
Yeah, so your first right of refusal is a shareholder right. So when you are a shareholder, no matter if that's a 20% or a 50% or an 80% shareholder, you'll have what is a first right of refusal to purchase the shares of a selling shareholder. So if partner A and partner B, and we'll say actually partner A, B, and C, they each have 33% holding, whatever that might be. If partner C wants to sell and leave, A and B will have the first right to buy those shares in their respective proportions that they hold. Again, this is dealt with under a shareholders agreement. If you leave it up to the Corporations Act and the replaceable rules, you can find yourself in some Barney. But it's, the idea is it makes it as fair as possible for all shareholders. If someone wants to exit, that's fine. There shouldn't be any animosity towards that. It should just be, sweet, we'll take your shares in the first instance. But if that preemptive right isn't actually utilised by someone, by another shareholder, so A and B, then C can go out and actually sell their shares to a third party. So, but that third party usually needs to be approved by other shareholders before they enter into the business.
Perfect. And what is the difference between a shareholders agreement versus a share sale contract and also an employment agreement, and can they all be tied into?
Yeah, so your shareholders agreement is completely separate. So that's your internal governance document, is what we like to call it. Is basically when you start a business with, especially with a couple of people, you'll have your shareholders agreement, which is your the way that you interact as shareholders pretty much, and it also deals with director resolutions. So what rights shareholders have to appoint a director and everything like that. So your share sale agreement deals with a share sale. So when someone wants to exit the company or someone wants to sell to a third party, a share sale agreement is prepared, and that has far different terms to a shareholders agreement. So it's just basically a different scenario. And then obviously your employment agreement is your employment with the company. And again, that's a different scenario depending on what industry the business is in. Okay,
perfect. And what are some little examples that you have found that people have put in shareholders agreement that's out of the ordinary? For example, where would I put that I don't want anyone to buy a car in the business? What if some shareholders decide they want to buy Range Rovers and others don't agree with that? Is that something you can put in the shareholders agreement?
You can be as detailed as you'd like. Company expenses, what we like to see, whether you call a Range Rover an asset of the business or not. I think they go down pretty quick, but but the way the shareholders agreement can be drafted is that for any asset purchase over $5,000 or $50,000 or $100,000 needs to be approved by shareholder resolution of say 75%, and then obviously they can't just go out and buy a Range Rover without getting the approval of everyone else. So you can get protective that way. And then obviously touching on the employment side, you can actually tie employment to shareholding, which is a funky one that we actually see becoming more of a norm now. Where you've got two partners or three partners in a business that are doing a startup. You've got partner A, B, and C, and partner A and B are really in there doing all the work. Partner C is just kind of chilling, and what he goes, hey, I'm not going to get employed in this business anymore. I just want to go surf and play golf. Tying his employment to the business and his interest in the business is key for shareholding. Otherwise, you got two guys funding another guy to go play golf and surf. So having an event of default occur then, which gives the right of those other shareholders to buy that guy out, basically.
I actually had an example of exactly that. We had a business, there was 3 shareholders in the business. They were all working 40 hours, and that was their kind of commitment. no shareholders agreement in place, obviously. Had a falling out, and one of the guys has said, like, look, I've lost my passion for this, I don't want to do it anymore. But the other two shareholders didn't want to buy him out because the amount of money that he wanted was obviously quite large.
Always is.
He resigned as a director, stopped working in the business, but he was always a 20% shareholder, and he just sat on the sidelines receiving his clip of a dividend every 3 months. So that actually went on for about 2 to 3 years. Ultimately caused the company to wind up just purely due to disputes and stuff like that. So definitely highlights the importance of having a shareholders agreement in place.
100%. You know, it's the most important document, I think, personally, you can get if you're starting a venture with anyone.
And when you say he wanted a large amount of money, how did he come to that valuation? Can you just decide how much money you want for shares, or do you actually have to get a valuation done by an accountant?
That's exactly what he did. I think he bought his 20 or 30%. From memory, it was probably around 20 or 30 grand. And he wanted 500,000. Just because of what he thought the business could do, and like, you know, the time and effort he's put in, and he wouldn't want to sell for anything less. That's usually the most common feedback we'll get from a client when we ask them, you know, have you come to this valuation? They'll usually say, oh, I wouldn't sell for anything less. Well, how did you know, is there any methodology behind it or anything like that? And it's usually just, you know, emotions and everything else from the blood, sweat and tears they put into the business, which is understandable, but you know, then it puts the other shareholders in a pretty tough spot. They don't think that it is what it's worth. So it can be hard, because that's something else you can add into a shareholders agreement, right? Is how the business is actually valued.
Correct. 100%.
Share sale.
Yeah, exactly. So you can put valuation. We always will put a valuation clause in there that will deal with that exact scenario. So how shares are valued on a share sale, how shares are valued on a share issue. Absolutely. We see people put family law events as an event of default. So if someone's, you know, unfortunately we're seeing it more and more often these days. If someone's subject to a family law event, being a, you know, de facto separation or a divorce or whatever that looks like, it's actually an event of default on behalf of that shareholder, which means, you know, you've got party A and B and now, you know, have the right to purchase party C out of his shares. The idea behind that is you've got party C in a divorce and his, you know, partner may end up with the shares in this business as a part of that property split, and then all of a sudden you're working with someone that has no idea about the business, has never had an interest in the business, you know, potentially has been on the sideline the entire time. So you don't really want that to happen. So we have that event of default clause in there, and that'll kind of assist with protecting, you know, honestly all of them. So there's that you can add in as well.
And if you're maybe boyfriend, girlfriend, you're about to get married, you don't have a shareholders agreement, is this something you can put in the prenuptial agreements, or would you still recommend having a shareholders agreement regardless of your...
Look, prenup agreements are, you know, not my direct area of expertise, but it's, look, you can divide, if you have started a business with a partner or something like that and you're about to get married, you can absolutely put the, you know, what percentage of that business each person, you know, actually contributed in that prenup for sure. Okay,
perfect. And Callum, just a follow-up question. What if a shareholder wants to bring in an employee as a business owner? Can they sell their shares at a really discounted price?
They can, but it can result in a tax event for the person who's selling the shares at a discounted price. So whenever you're doing any transaction, the ATO generally wants that transaction to occur at what's called market rates. So if you're providing a discount, what could happen is the market rate substitution rule will kick in, and the shareholder who sold the shares will still have to pay tax on what's considered the market rate, not the discounted rate. So then the actual person selling the shares, trying to do a nice thing, give it to them as a discount, ends up still paying tax on, you know, the normal rate. So something definitely to take into consideration before, you know, just doing that.
And with that as well, you've got things in the shareholders agreements that's called good leaver and bad lever provisions. So if a shareholder was to exit for a, you know, as a good lever, you know, they get paid their 100% value of their shares. If they exited a bad lever because they've, you know, something bad's happened, you know, then they can actually get they have to sell their shares at a discounted rate to those shareholders. You know, we normally see that at sitting around 80%. You can actually run into some trouble if you discount it too much. You get ASIC penalties for, you know, penalising a shareholder and things like that for, you know, dropping it down too much. So it's a tough area, and I'm sure it'd cause a headache.
Definitely.
And for business owners listening that are thinking about bringing employees on into the business, can you put clawback clauses into the shareholders agreement if they were to leave within a certain time frame?
Yeah, absolutely. We see it all the time. You know, we've got a new venture for a client at the moment where he's introducing two employees as 15% shareholders.
Okay.
And those shares actually vest over a period of 5 years. So, each year they'll get a certain proportion. So yeah, absolutely, we see it all the time. And if they leave, again, that's why you tie that shareholding to the employment, so that if they leave, the company can buy it back or other shareholders can buy it back. So it's pretty important.
Okay. And what is your experience with clients going to court over shareholders agreements, and what have been some outcomes?
Look, we do pretty much everything except criminal at MBA, and litigation's not my direct specialty, but the idea is I have to have a decent knowledge to try and prevent this happening.
Of course.
But yeah, look, it's we see it all the time, and honestly, it's more so when shareholders agreement aren't drafted. Not having a shareholders agreement can basically just cause an absolute mess, because you've got to rely on the Corporations Act and the replaceable rules, and some common law precedents and things like that. And a lot of the time, we have a client that purchased a property in Mermaid Beach with 3 other unit holders, and that those unit holders, they're living the dream. The property's gone up. Our guy wants to cash out. None of them want to buy him out because and just to confirm, a unit holding agreement is pretty much the same thing as a shareholding agreement. So again, just the relationship between parties that are involved in that venture. So they didn't get a unit holders agreement in place, so they have to rely on the unit trustee, and that didn't actually give him too much of an out. So that's still ongoing at the moment and costing everyone money.
Good for you guys.
Yeah, look, good for us. But honestly, the money it costs to get that shareholders agreement in place, get that unit holder agreement in place straight away will save you so much money down the track. Or the idea is that it does.
So in terms of the shareholders agreement, if one person breaches the shareholders agreement first, but then someone else breaches the shareholder agreement after, is it just whoever's breached it first, or whoever?
Yeah, well, I mean, look, there's still 2 breaches, so you have to treat them as they are. So, normally, again, the idea for a shareholders agreement is, you draft it to rely on down the track. You don't necessarily draft it because you're going to follow it by the book every day. But if you've got someone that breaches first, you've got another guy that breaches after, you still got to deal with that the same as you would. Give them a chance to kind of remedy that breach if it's possible, and then if it's not, then you can deal with those event of defaults and things like that there. But again, those preemptive rights and things like that will kick in for those defaults.
Okay, Callum, some accounting questions.
Sure.
Can you be a shareholder and an employee at the same time? What would be the benefits?
You definitely can. It's quite common. So if you're operating a company and it's your business, you'll commonly be the shareholder. To take money out of that company as the owner, normally you would do that as either a wage or a dividend. So if it is a wage, then you'll technically be an employee of the company, entitled to superannuation. There'll be PIG withholding on the wage. So very common. And the benefit really is that you can actually take the money out in a different way versus just a dividend.
Okay. And then in terms of dividends, who decides when these get paid out? How often can you do it? How does it work from a tax point?
So in terms of who decides, it's ultimately the director. In terms of how regularly you do it, when you do it, and the like, it's really going to be dependent on, how much money we've got in the company. Important thing to note is dividends are paid from what's called retained earnings, not your current year profit. So, it's a company profit that it makes during the year, pays its tax, then the remaining cash at bank is your retained earnings. So that's what you actually pay your dividends from, not what you make during the year. So, you can't pay any dividends if you don't have any profits from the prior year. Also, we have to be mindful of franking credits. So franking credits is the tax that the company does pay on those prior year profits. If you take a dividend out and there's no franking credits, it means you're going to have no tax attached to the money you're taking out. So it's generally more favourable to pay a dividend when there is, those tax credits there, because when the owner takes that money out, it means they're going to get a tax relief because they're going to be able to claim back some of the money that the company's already paid. So we have to be really mindful of what is the franking account balance, making sure that it doesn't go into a deficit at the end of the year. If it does, you may then be liable to pay franking deficit tax, which isn't pretty as well. So it really comes down to a lot of things to be mindful of. In terms of regularity, monthly or more frequently than that can be quite hard to manage in terms of looking at your franking account balance, looking at how much retained earnings you got left, what your current year profits are, any tax payments during the current year. So more commonly we'll see either quarterly biannually or annually. Annually is generally the easiest because you've got your prior year earnings, you pay the tax, and you pay a dividend afterwards. So you've kind of mitigated a lot of the variables. But sometimes people want to take more money out. So yeah, like I said, the more kind of common payment methods would be quarterly or biannually.
Okay, can you just dumb down franking credits for me a little bit more?
Yeah,
so what you're saying is the company pays tax on the profits, and then when I get the money as a shareholder, I don't have to pay any tax on that money?
Yeah, let me give you a really easy scenario to hit the nail on the head. So let's say we've got a company, it's made $100,000 of profit before tax, right? Company tax rate's 25%.
Yeah.
So we've got $100,000 of cash in the bank from the profit. Company has to pay that $25,000, either 25% to the ATO.
Yeah.
After the year's done, there's going to be $75,000 left in the bank account. 100 less than 25. Owner goes, cool, I've got money in the company bank account. I want to take that out. I'm going to declare a dividend. So we do a dividend of $75,000, the remaining cash in the company bank account. That then is income to the shareholder. Because that 75 was originally 100, they get to claim back the 25 that company's already paid. Otherwise, if they were paying their tax rates on the 75, that income's being double taxed because it was originally 100, now it's 25. Now it's 75. So the shareholder gets to claim back the tax that the company's already paid. They have to record that as income, which is sometimes quite a misconception. So they actually record 100,000 of income in their own name. So then they pay their marginal tax rates on that 100,000.
Okay.
So let's say their marginal tax rates are 34.5%. They would then be paying 34,500 on that original 100,000. But they get to claim back the 25 that the company's already paid.
Okay.
So they'll just pay the difference between the 34.5 and the 25, which is 9,500. So ultimately that income's only being taxed once, right? Because we've got 100,000 tax at the company level, then goes to the shareholder, they record that income in its kind of previous state. They pay their, what we call their top-up tax or their marginal tax rate, but then they get to claim back the 75. So going to hit the nail on the head, you'd have your original 100, company pays the 25, shareholder then records that 75 plus the franking credits as income in their name. They don't pay the full 34.5. They just pay the difference, which would be 9,500.
And that's why you get an accountant. Everyone.
Dumbing it down wasn't very dumbed down. Unfortunately, Australian tax law isn't very friendly in terms of trying to interpret it easily.
I can imagine. But in the case of, let's say one shareholder is in absolute growth mode and they just want to reinvest all of the profits, and another person has just gone out and bought a Lamborghini and really needs some money, that's dealt with in the shareholders agreement in terms of the dividend payouts. Is that correct?
Just at a board level. And I was going to touch on this as well. Dividend policies are, where you're starting a new venture, they should kind of, from my personal belief, should be a back end thought. Shouldn't really be a thought to start. Obviously you need to make sure you still got some expenses to live, but if you're in a growth mindset and you need to grow, your money should be reinvested into the business. So, and we've drafted dividend policies around that, but again it depends what those business partners want to do. But ultimately it should be, hey, let's reinvest, let's grow this thing, and that's kind of where you should sit, where you got a new venture. After a couple of years, then probably worth thinking about, hey, let's actually put together a more frequent, you've got better cash flow, what your monthly, and honestly I agree with Cal, is quarterly dividends probably make more sense. But at that point you can start thinking a little bit more into it.
Okay, perfect. Okay, so Callum, can a shareholder be a trust or another company? Do you usually recommend an entity to be the shareholder or just an individual?
Definitely can be either a trust or a company. A lot of things have to be really mindful of here. When we're looking at who should be the shareholder, we want to obviously look at asset protection as well as tax minimization. So if we've got a trust with a company acting as the trustee or a company, what that will mean is those shares are held in a separate legal entity, which will give those shares more protection if it was, I guess the alternative was for those shares to be held in the director's personal name. So that's one thing that you get a benefit of holding it under either a trust or a company. Holding under a company is generally not something that we would recommend. And the reason for that is companies aren't eligible for what's called the 50% CGT discount. So if you're a shareholder, you buy into a business and you hold those shares in a company, you hold those shares for longer than 12 months and you grow the business, quite well. If you then want to sell your shares, you're not going to be eligible for that 50% CGT discount, which may mean that you pay more tax. Trusts are eligible for that, so we'll generally lean toward the shares being held in a trust. How trusts work is they don't actually pay tax. Whatever income is made in a trust, whether it's dividend or capital income from when you do sell the shares, gets distributed down to beneficiaries. So it gives us a lot more flexibility, because if it's a family trust, we can obviously look at the low tax environments. So whether that's, it's, other family members, or it could be spouse, or whoever it may be that has lower tax rates, we actually then try and distribute some of that income to those lower tax environments, ultimately bringing down the effective tax rate for the whole family group. So trust is usually the route that we'll lean toward, but in some instances, a company can still be favourable.
And if I set up a company now and I just put myself as an individual shareholder, and a year down the track I decide I want to move the shares into a trust, do I have to pay tax? Do I have to pay CGT tax on the transfer of shares to my other entity?
Yeah, so that's a very common situation, and when you're setting up a business, it ultimately comes down to looking at the costs, and setting up a trust with a company can be not as appetizing, because it does cost more. So very common scenario, we'll have company, individual shareholder, they'll want to start flowing dividends to maybe their spouse, or to parents who are working, they've got a lot of tax rates or something like that. So they'll go, hey, look, I don't want to keep receiving these dividends in my name, can I give them to my spouse or someone else? We'll then go, you can do that if you do have a trust as a shareholder. And then the $1 million question is, well, how do I move the shares from me personally to the trust? A lot of the time they think they can just gift the shares over, or just transfer the shares. But unfortunately, like I said before, all these transactions have to be done at market rates, and that's what the ATO wants. So we have to do a valuation on the business to see what it's worth to then transfer those shares at that market rate. If the business has grown, it's doing quite well, and it's now profitable, it's going to be quite likely that the value of that business has increased, which then may mean that individual shareholder has to pay tax on the transfer. So there are some capital gains tax concessions that the shareholder can rely on to reduce that down, and potentially make it nil if they put it to super or a few other things. But it's definitely something you want to look at early on, and that's why we generally will always advise to try and get your structure right in the first place, because it can save you a lot of money down the line with things like transferring the shares over.
Of course. So if I am running a business through a discretionary trust, or just under a personal ABN, can I bring on additional business owners?
No. So trusts don't have definable interests, so you don't have shares or units in the trust like Jameson's mentioned before. So if you're operating a business in a discretionary trust, you can't give someone a portion of that. The trust either holds assets or operates a business on behalf of the beneficiaries. There's no definable interest as to what beneficiary owns what. So really important, again, to speak to your accountant or even a lawyer in this case to see, well, what is the best structure for you from that kind of practical sense. Because if you do have the intention of trying to bring someone in down the line, you want to make sure that you've got the right structure to facilitate that. That goes the same for an ABN. As a personal ABN, you are the business. You can't cut off an arm and give someone 10% of your business. It's essentially you are that business. So it can be really hard in situations like that. The only way you can really kind of look at it is if they are working in the business, you can pay them as an employee. But you can't actually give them equity in it.
Okay. And something we've seen from nasty splits of shareholders is share diluting. Do you guys want to talk about what that is and how it can affect an existing shareholder?
Yeah, so just from like a really high level kind of accounting perspective, share diluting is essentially when shares are issued to reduce the shareholding percentage of the existing shareholder. So let's say there's two partners in the business that each own 50 shares each. So the total shareholding in the company is 100, 50 plus 2, 50 times 2. If we then want to bring in another shareholder, as opposed to selling the shares, if that company then issues another 50 shares to shareholder C, that will then mean that all shareholders own 33.33% each. So original shareholders A and B have been diluted down from 50 to 33.33. So that's share diluting in a nutshell. How that operates from a legal standpoint is probably a better question for Jameson, whether you can actually do that or not.
You can. And it's something we see often where, and I'm not an accountant, so please step in if I say something wrong, but where people want to avoid those CGT scenarios, and they want to issue shares in a company rather than do share transfers,
Yeah.
and it's just a way of avoiding those CGTs. But the issue of shares normally will stand to be a shareholder resolution. So then that can vary from depending on what percent the shareholder agreement says. That could be 75%, that could be 85%, or it could be a unanimous decision.
Yeah.
So it could require everyone to go, yeah, we're happy to dilute our shares, basically. And yeah, like Cal said, it's really utilised around where a company wants to capital raise, so influx some money into the business if they've got new things that they want to try and venture out and do. If they've got products they want to start some more R&D on, things like that, whatever that may be, it's utilised for that.
Yeah. So from a tax perspective, you mentioned before, like, can you do that or not? From a tax perspective, there's no issue with issuing shares if they're done at market value. If you issue shares less than market value, if the loss or gain in the original shareholding is greater than 150,000, then that's where it can actually create a CGT event. So on the early stages of the business, it can be quite common to try and bring that other person in without creating a CGT event. But we have to just make sure that it does abide by the general value shifting regime, because that's where other CGT implications can still arise.
Okay. Controversial topic. I am a sole trader, so I just work under my personal ABN. I started my business years ago. It's doing amazing. I'm ready to bring on some additional business partners. I need a restructure. Who am I coming to see? A lawyer or an accountant?
Both. Common practice is usually they'll reach out to the accountant, and that's just generally because they have probably more frequent touch points with the accountant. An accountant or a good accountant will have a good oversight on how the business works and kind of the general commercial nature of things like this. So usually they'll have the concern, speak to the accountant, and then the accountant will handle the tax side of things. But then generally they'll recommend making sure that all the agreements and actual legal documents behind it all are obviously done by a lawyer.
Yeah. What if I have assets under my personal name that are tied to the business, and now I'm setting up a new entity? Do I transfer everything over?
It'll depend on how you do it. So we'll have to. There's a few different pathways on how you can restructure a business, and they all have different tax consequences and other kind of legal implications as well. So that's where again your accountant or lawyer will kind of look at your options and present option A, B, C. Each will have their pros and cons, and then it's ultimately up to the client what they want to do.
Awesome. I feel like that's probably a whole other podcast
episode.
You
agree. Honestly, yeah. 100%.
Okay, awesome. So if someone is suing the business, can the shareholders be affected in terms of assets? Assets?
They could lose their business, so they could lose their income. But no, look, they're only liable. So the whole, their liability is limited to the amount unpaid of their shares. So, for example, if someone starts up a new $2 company and it costs them $120 to issue 120 shares, and they've only paid $90 of those shares, they're going to be liable for that $30 that's still outstanding, because that's technically an asset of the company that needs to be paid. So that $30 is then attributed towards repaying creditors or repaying someone that sued them or whatever it is. So they're only liable for their shareholding proportion that remains unpaid. So that's pretty much where their liability stops. So your house, everything like that.
Do you see that commonly? Because I actually see that quite commonly on my side, where we'll get a new client on board, we'll add the company to ASIC, and we'll have a look at the shareholding. We might sometimes say that there's 150,000 of unpaid shares. So is that ever come to issues? Do you have any scenarios around that? Or?
Yeah, it sometimes can. I mean, it probably comes more on share issues rather than transfers. I mean, your issues. We've got a client recently where we're currently undertaking a share issue for, I think her value was like 2-point-something million. And the issue will be a vendor finance situation. So then you've got to comply with, without getting too technical and boring, your 260B waivers, things like that, under the corporations for shareholders to or companies to vendor finance these situations. But again, it's a loan scenario, right? So you've got a $2 million liability that needs to be repaid to the company, and what portion of that is actually repaid at that current time. You've got a shareholder liability that, say, if it's going to be repaid over 5 years, let's say in 2.5 years something happens and the company gets sued, then technically there's still that unpaid portion there. So definitely something that people don't think about on the back end, but for sure something we can.
A lot of the time I see is when there's like sweat equity that the owners are trying to achieve. So they'll have there'll be a business owner, so shareholder A, they'll have an employee, they'll want to issue them shares, but usually the employee, won't pay for it. So they'll go, look, invest extra amount of time and we'll start recording it from unpaid to paid.
Yep.
A lot of the time I don't think the employee that's becoming a shareholder actually understands that they're still liable for those unpaid shares. So something to be really mindful of.
100%.
If you do have unpaid shares, it's not a pretty...
No, I mean, the reality is you can get, this company gets sued and you're all of a sudden sitting there, you got to cough up tens of thousands of dollars or in some cases hundreds or millions. So it's especially in that scenario for sure.
I think there's a couple of people asking what is vendor finance.
Yeah, right. Well,
in a very short form.
Look, it can happen in a variety of scenarios. We're seeing it more and more with business purchases at the moment. So where someone wants to buy a business, you've got a vendor finance situation where that company or that shareholder or the owner of the business will say, hey, look, happy to transfer you the business. We'll pay you, and it can be worded as an earnout or whatever it can be. But we'll, you'll pay me over. We ideally don't like to see it for more a period of 12 months or more, but you just basically pay reoccurring fees every month or every quarter or whatever it is, and the reason sometimes we're probably seeing it more now than ever is you've got a lot of businesses that are being sold that are subject to one head of the company, one guy that produces all the income, and if he leaves, then where are these clients going to go? So the idea is you tie it into the performance of the business, so if it consistently hits the numbers even without that guy there, happy to pay that value figure, but if it doesn't, and it doesn't hit those figures, then it's obvious that it's a pretty big detriment to the business for this guy to leave. But we've bought it, so we'll drop the value down and you don't actually get those payout figures. But that can look like, on a really surface level, it can basically be you got $1 million purchase price, you might pay $700,000 up front, and you'll vendor finance $300,000 as like an earnout kind of thing, and you'll pay it over a 12-month period based on performance of the business.
So it's pretty much the actual business profits that pay the difference.
Correct. Yeah, exactly right. And honestly, we have seen scenarios where there's actually no money up front. We've had a tattoo parlor previously last year that actually did that, where he said, you can have the business straight away, run it, and then you'll just pay me the $150,000 value over 3 years.
Very common. We see it a lot here.
It's just people are less risk intensive these days, so people want to try and off risk themselves as much as possible. So if you can tie it directly to the business performance, then it's beneficial. But obviously, we'll try and we'll put a bunch more detail in there.
Something to be mindful of with vendor finance, guys, is it can create a really nasty tax consequence. So essentially, you're using the company's profit to buy the shares that you've acquired in that company. Company can't own its own shares, so it's either an individual or, like I said before, potentially a trust or a company. If you're using the company profit to pay off the shareholder, the exiting shareholder, the way you'd have to do that is by way of a dividend, or it could either be a loan. If you're doing it as a dividend, again, it's going to be depending on how much franking credits there is and the amounts that you're taking out. In that scenario before that you mentioned, if you've got $700,000 as the deposit and $300,000 as a difference over 12 months, that means you'd have to declare a $300,000 dividend to you personally, which again can create quite a nasty tax implication. Anything over $180,000, you're paying 47% tax on, so a pretty penny will be paid on that tax bill. And just remembering, if you're taking that $300,000 out to pay the exiting shareholder, you don't have $300,000 in the bank, you've given that to the other person, so then you have to cop up the 47% on that $300,000 yourself personally. What we commonly will see is they'll take the money out in the form of a loan versus a dividend, which then will fall under the Division 7A tax implications. So vendor finance is good if it allows you to be able to buy the business and make the whole transaction work, but it usually results in a pretty nasty tax implication. So always speak to your accountant, make sure you get the right advice before undergoing that, for sure.
Yeah, and that's what I was talking about before with the share issue of $2 and a bit million. That's a Div 7A loan. So
nice.
So there's 1,000 ways you can skin a cat, but vendor finance is just a much more common thing these days. So.
Cool. So if I want to sell the business, my other shareholders don't, but they also can't afford to buy me out, where do I stand?
That's a fun conversation. Do you have a shareholders agreement? So where a company owns a business, or where a unit trust might own a business, or whatever the scenario is, you've got a business that needs to get sold. That business or selling that company's core business will usually need a unanimous decision.
Okay.
If you're talking about the shares in that company that owns the business, if you're a shareholder and you say, hey, I want to leave, and these guys can't afford to buy you out, again, you can introduce those vendor finance provisions.
Okay.
Alternatively, they'll have that first right of refusal, and they'll say, hey, yeah, if I want to buy it, I'll buy it. If I can't afford it, let's do this. If not, then that person might actually go, hey, I'll go to market with my shares and see if someone wants to buy it.
Okay.
If they go to market and someone's interested in the business and they say, yeah, cool, I'll jump in, I think I can contribute X, Y, Z, then you've got shareholder those shareholders that are remaining have to basically say, yep, I'm happy for that person to be in there. Otherwise, you just keep going in swings and roundabouts. So.
Okay, cool. So going back and forth with my accountant and lawyer, all these fees are starting to add up. Callum, are they tax deductible?
Yeah, as long as they relate to the business, they'll generally be tax deductible. The common scenario that we see with legal fees where they aren't deductible is if it's a shareholder of the business and they're using the company money to pay for a potential marital breakdown or something like that. Obviously, a marital breakdown doesn't relate to the business, so that wouldn't be deductible. But 9 times out of 10, most legal fees, if it relates to the businesses and there's a clear nexus between the earnings and the expense, will be deductible.
Okay, awesome. I think you had some questions for Jameson as well, Callum.
I do.
I'm starting to be ready, mate.
Okay, so first question is, what are directors' duties?
So your director's duties are so where you're a director of a company, you've got a requirement to, there's from the top of my head, I think there's 9 or 7 of them or whatever they are.
Sure.
But they fall under the Corporations Act, and they're a requirement for directors to act in a certain way.
Yep.
If you fail to act in those ways, so briefly, it's act in good faith, don't trade insolvent. Those things basically, not misuse, no misuse of information, declare conflicts of interest, so you can't vote on matters that will actually personally benefit you. If you're doing those things and you're found to be doing those things and you're acting against your director duties, you can fall into some pretty significant ASIC penalties, and you can find yourself in some hot water pretty quick.
Yeah, so when operating through a company, usually the director is separated from that company, right?
Yeah, well, that director, so if a business is operating as a company, yes, that director will sit on the board for that business or the board of that company,
Yeah, but if someone's, suing their business or something like that, they're generally suing that company, right? Not the director in a personal capacity.
Yeah.
Correct me if I'm wrong, but if those director duties are proven to be failed, then that's when that veil can essentially be lifted.
Correct.
And that creditor of the company can come after the director, right?
100%. So if you're found as a director to be taking ridiculous remuneration, taking a heap of, whatever it is, you're not avoiding conflicts of interest, you're running it into
not
the
paying your
ground,
bills
you're
on
not
time.
paying your bills, you're trading insolvently, whatever it is, so you're not paying employee super, all that stuff, you can absolutely get put on the chopping block.
Yeah.
And directors of companies are in most scenarios, where you've got leasing and things like that, you're normally the one to provide that guarantee. So as we touched on before, trying to off risk yourself and make sure you hold everything outside.
Very important for listeners to know, because it's a common question that I get asked, and that's Cal, if I'm operating through a company, I'm pretty much sweet, right? I can do whatever I want, and my personal house and everything like that is protected. But if you're running the business into the ground intentionally, that would generally be failing your director's duties, and that's when that whole protection scheme can be unlifted and put on the chopping block.
And it's funny, like you've got director duties that are as little as keeping good books and records. So people failing to do that, technically you're in breach of those fiduciary duties of directorship, and you can find yourself in some hot water if ASIC ever come knocking. So probably one of the most key things is to get online, have a look at those duties. Are really accessible. Go to the Australian Institute of Company Directors, have a look there. When you get your director ID, there's director courses that you can do. The more that you do those things and more that you stay up to date and do yearly courses on those director duties and things like that, the better chance you're not going to find yourself in hot water. So
director's duties to keep accurate records and...
So you've got to keep accurate records of your business, accounting, everything like that.
Do you hear that, everyone?
So go to a good accountant.
Keep your books up to date. Very important.
Go to a good accountant.
It makes sense, right? Because if you don't have accurate books, you can't see whether you're trading solvently or not, right? Correct. You could be 100% trading solvently. You haven't reconciled your books in the last 2 or 3 years, and you'll think you're making money when in reality you're not.
Yeah,
so
correct.
Again, it just highlights the importance of having accurate records, everyone.
Yeah, 100%. Have a good accountant. Like you
like
are.
it.
And every year when your annual company fee is due, you actually have to state that you are trading solvently.
Correct.
You have to sign off on that every single year. So.
Yeah, exactly right.
Cool. Next question I had is, what risks do directors of companies or corporate trustees have? So we probably briefly touched on that, but do you want to elaborate a little bit more?
It's honestly, it's just that risk of if you go against your duties and do something wrong, then your head's on the chopping block. It's probably the easiest way to do it without diving in too much. Your corporate trustee scenario where you're acting as a trustee of a trust, then you're actually acting, in the best interest of beneficiaries.
Sure.
And then you've got a whole other world of you got the Trust Act, which you got to rely on as well. So
you've
got all these trustee, you've got trustee powers and things like that you need to follow. Again, if you break that, then you could be on the chopping block as well. So there's heaps of guidelines and things like that. But it's important just to be as open and honest and just good person.
I like it. We've talked about shareholders agreements. We've talked about unit holders agreements. What about a partnership agreement? Are they important, and would you recommend one?
Yeah, absolutely. So partnerships I personally believe partnerships are probably a bit dated in their use.
Agreed.
I think it's an act from 1891 or something like that, the Partnership Act. So
pretty old.
It's and I think it hasn't been touched on. It hasn't been updated since 2012. Could be wrong. Could be spitting absolute lies here. But look, it's partnerships are good there, but your partnership agreements will deal with splits of profits. Who's liable, who's liable for losses, things like that. So they're really, really important because again, they govern the relationship between everyone. But if you're thinking about a partnership, just don't.
No, agreed. With partnerships, everyone, to set one up, it's as easy as going on the ABR, and me and Hannah could register a partnership right now in 5 minutes.
Correct.
There's no, requirements on how the profits are distributed or anything like that, or who's contributed what assets and who's entitled to take that kind of asset back out. We see this all the time as accountants. There'll just be two friends, they're going into business, they go, yep, cool, we're going to split it 50-50 or 70-30, whatever it is. They register a partnership ABN on the ABR, and then they come into some hot water down the line. So I personally do agree that they're quite dated. They do have their place. Partnership or family trust can be quite beneficial from a tax perspective when you've got property and so forth involved. But again, when it comes to structuring, guys, just make sure you speak to the right people, such as a lawyer and accountant, to get the right advice, because there's so many considerations to take into account.
Yeah, for sure. I've got a mate that started up an online, like an e-commerce kind of page for sweets and things like that. They've got a partnership at the moment, and I've kind of said to them, hey, look, probably best to move out of that whilst it's not valued too high. You can sell it off at a pretty low rate. It's they've realised how frustrating a partnership can be. So moving across and getting the right docs and things in place are the best idea.
Okay, cool. Common question we've been getting asked as of late, with the property market being so hot right now, is joint ventures and partnerships. What's the difference between a JV, or what is a JV, and what's the difference between a JV and a partnership? Yeah,
so your partnership is a continued basis. Your JV is for one specific purpose.
Right.
So you might have a JV or a joint venture. So a joint venture is pretty much an agreement between two or more parties that say, hey, this is what we're going to do. This is exactly what we're going to do. We're property development. We've got a client up in Harvey Bay that's doing one at the moment. If you've got they're doing a joint venture with another company, that company will act as a project manager, but they're the people who own the land. So you kind of get people with different skills normally involved in the joint venture. Your joint ventures are really useful because they're as I said, you can kind of just partner people in with different skills in the relevant areas. They're a little bit different to the partnership because they basically end once that project or whatever is completed. So that JV is again, need a joint ventures agreement. Because that will govern and detail the governance obligations of each party. So things like financial contributions, profit sharing, termination, but the number one thing we always see an issue with in the JV is at the end of this whole project, who owns the intellectual property of it. And dealing with that is probably one of the most key things, because you've got things that you've worked on, in some cases 24, 36 months. At the end of it, where does that all kind of go?
So a JV is not a separate legal entity though, right?
No.
It's just an agreement between the two people.
Correct, to do a certain task, pretty much.
So who has the bank account?
That's all dealt with under the JV agreement. So
So a common scenario could be, actually operating the operation as such through a company. Then there's a JV between a builder and a project manager on how they're going to contribute what skill set and resources to that company.
And it's honestly, you're more so better to use it in the property market. It's a much more useful tool in the property market than it is elsewhere. You wouldn't really do a JV if you've got an accountant and a lawyer. You just put it onto one company more than likely. So
then we'd have a shareholders agreement between you and I as to what we're contributing to the business.
Correct, exactly right. So
cool. All right, that's all the questions I have.
That's it for me. Did you want to touch on anything else?
There's nothing really I want to touch on. I mean, you guys covered most of it here, so no, I appreciate you guys having me on. And
thanks for coming.
Awesome.